What's up, everybody? Welcome back to another episode of Economic Events. Today I'm going to be reading an article from TheStreet.com. Sitting on cash? High interest rates could make this a solid investing strategy. The article provides guidance on what to do with your cash amid rising interest rates. It suggests that as interest rates increase, savers should consider moving their funds into high-yield savings accounts or certificates of deposits to maximize returns. These options typically offer better interest rates than standard savings accounts and can help grow your savings more effectively in a rising rate environment. The article also emphasizes the importance of diversification, suggesting that investors should consider allocating a portion of their cash into investments such as stocks and bonds. This can help mitigate the impact of inflation and potentially yield higher returns over time. Additionally, it advises reviewing and adjusting your financial goals and risk tolerance in response to changing interest rates, as this can inform your investment decisions and saving strategies. So, to the 7 people in the entire United States that are sitting on cash right now, you're gonna love this article. The rest of us who aren't necessarily sitting on cash, I don't know how this really would apply to you, but again, for you, few people in the world in the United States that are sitting on cash that have cash laying around, this is probably a decent idea for you because typically what's going to happen is as they continue to raise interest rates, which I don't think the Federal Reserve is going to stop anytime soon. I think they're going to, as of right now, the federal funds rate is about 5.25% to 5.5%, and I'm thinking by the end of the year it's going to be 6% or above 6%. So I know that they have a meeting in September, and I think they have another meeting in November or December, one of those 2 times, which again, I'm not going to be surprised if they do 50-point hikes in at least one of those meetings. So now, putting that aside, if you are one of the few that is doing good economically in these inflationary times, and you have cash, putting it into a high yield savings account is not a bad idea to kind of get some extra grow your savings a little bit more. Because I know, for example, you go to Regions Bank, or you go to Bank of America or Chase or JP Morgan. They're offering 0.1% on your savings account, which is nothing. You're talking about if you put in $1,000 into their savings account, by the end of the year you're gonna get $1. That's not nothing right there. Whereas I think there's a lot of high yield savings accounts. Ally has some, and then there's Discover Financial Services. They have some as well. I know Discover, they have theirs close to 5%. So if you've got your money in Bank of America or JP Morgan and you're not happy with your savings results, you go ahead and put it into one of these, and let's say you put in $1,000 and you get 4.8% on that. That's gonna be about $45 to $50 a year is what you're gonna get. So that's a huge discrepancy as in return there. So pretty good opportunity for you, especially with the official consumer price index as of today, based off August reports, is 3.6%. So if that's 3.6% and your high yield savings account or even your certificate of deposit is giving you 4.8% or even 5%, you're ahead of the game right now on inflation. So you're doing pretty good there. If you're not comfortable being in the stock market, which is fine, because it can be a little bit overwhelming if you see you put in, let's say, $1,000 into the S&P 500, and then you see every minute throughout the day that it goes up and down, up and down, up and down, up and down. That can be a little bit daunting. So if you want to go with a little bit of a more conservative approach, you can put your money into the certificate of deposits. Now, the thing is with certificate of deposit, they have timelines. I think the minimum is 6 months, and I think the maximum is 5 years. And if you put your money in there short term, you usually get a higher interest rate of return. versus if you lock your money in for the next, let's just say 5 years, your interest rate is going to be a lot lower. Like I think specifically with Discover Financial Services, if you put it in the I think it's a 6 month or the 9 month CD, you get 4.85, versus if you put in the 5 year one, you get 4.15. So we're talking about a 70 point discrepancy there, which is huge. So that tells me that banking or these banks are holding their contention on future interest rates not being as high as they are now. So that's the reason why the interest rate of returns are lower the longer you lock your money up there. So and I think with certificate with CDs, you get penalized if you take your money out before then, versus with a savings account, you don't get penalized for taking your money out there. I think you just get a certain amount of withdrawals a month. You know, some of them do like 3 withdrawals a month, some of them do 10 withdrawals a month, and if you do above that, I don't know what the penalty would be. You're gonna have to speak with hopefully there's a banker in the comment section that will be able to answer all these questions for you guys, because I don't have those answers. So you know, I'm not mad at this idea. I like it. You know, anytime you can diversify your portfolio, and this is another form of investment to a certain degree. You know, a couple of years ago, when interest rates universally at banks savings accounts were, you know, less than 1% or less than 0.5% in some cases, most cases, it wasn't really it didn't make sense to put your money there. But with a possibility of a stock market crash, it's not a bad idea to put your money in here. You know, you put, and they talk about another thing they say is, you know, put it in some treasury bonds. Those are kind of in line with the CDs and the savings account rates, so you're not really getting much of a difference there. Again, it's just putting your money somewhere else, where with the treasury bonds, your money is backed up by the United States, whereas, you know, you put your money into Ally Bank or Discover Financial Services Bank, it's backed up by that company not going out of business. So again, earlier in 2023, we had several banks go out of business. So you know, you do what you want with it's your money. Do whatever you feel comfortable with it. But that's for the people who have money to do it. And now it's for the other people that don't necessarily have $1,000 to put into these savings accounts, which that's not the minimum. I just happen to make that number up in my own head, so I don't want you guys to think I need to get a minimum of 1,000 to put it in there. I think they do as minimum as low as like $30 or whatever. I don't exactly know, but to you guys, I guess one thing you can do is you know, focus on somehow lowering your expenses. Maybe with gas prices going up a little bit more and more. Another thing you can probably do is kind of consolidate your trips a little bit more, and do it to where you know, because a lot of times what happens is you'll go to Walmart for something, and then you're gonna go like an hour later or a day later, you're gonna go to Kroger for something else. You know, find a way to where if you can get all your stuff in one place, or, you know, if you can do it to where if you can find a way where it makes sense for you to, if you have the time to do them both in the same day at the same time, you know, I don't know, maybe find some people that you're really good friends with at work, and maybe carpool. One week you drive, the next week they drive. You know, if you feel safe enough to drive with these people and let your coworkers know where you live. Again, I'm not suggesting that, so I don't want you to something happen to you and this comes back to you're blamed on me, because I that's not necessarily advice. That's just things that I just put out there, ways for you to save money. So hopefully those work. But again, if you're if you're sitting on a lot of cash in this time, it's not a bad idea to put some money in cash, put some money in cash, put some in savings, put some in CDs, put some in bonds, put some in stocks. You know, if you're not confident in the stock market in the coming future. Me personally, I'm not necessarily confident with the stock market going forward, and in the near term at least. I think that we're due for a correction. That's just my opinion. That's not financial advice or anything. So you do whatever you feel comfortable with. Once again, I hope you guys enjoyed this video. Remember to like it, subscribe to the channel, and comment down below and let me know what you think. I'm looking forward to what you guys have to say. Hope you guys enjoy this one.